Hey everyone, an exciting and timely show for you today. I'm bringing back Anna Kelly. It's Wednesday, and we're going to do our expert conversation. And today, we're just going to talk about lots of random stuff. So, how you doing this morning, Anna?
I'm doing great, Michael. How are you?
I'm doing very well. I think the first topic the kind of elephant in the room for you and I that everybody is wondering is, as landlords with a decent amount of units, how has April rent collection been? So, you want to tackle that topic first?
Sure. So I think it's very MSA specific,
Mm,
meaning whatever your location and market is and how the economy is in that area and the type of industry in that area really impacts who's been laid off and
hmm
who's still able to work from home.
hmm
So I have some properties in Pennsylvania and Atlanta, and they're very different. So the ones I have in central Pennsylvania near Hershey, there's a lot of hospital employees. There are a lot of trucking companies and
mm.
distribution and warehouse companies, and most of them are still working, which is very good for them and for all of us. And so my collections on those buildings in the Hershey area, two complexes, I'm at 97%.
Oh, wow.
One complex, we're at 92% right about.
hmm
And in each of those, we have one to two people who have asked for a payment plan who have been impacted
Okay.
by this, have lost a job. Then the stuff that I own personally, also kind of in the same area, I'm at about 95% collections across all of them. And
Wow.
a couple of, my LLCs are hit a little harder. They're more like the random, the house, the 4 unit, the duplex. And those that have been impacted, all of them have reached out. I've reached out to them, and we've worked together. They've made a payment,
Mm.
and they've either lost a job or temporarily been laid off. So April looks pretty good. And I think May, is probably going to be a little worse if this thing continues. But everybody was really worried about April, and April is really good so far. So I'm very, very grateful. The stuff in Atlanta, we have two complexes there with two totally different demographics in terms of where they work.
Mm.
And one complex, as of Monday, was 81% collected,
hmm
which is about normal. Usually it's about 83% collected, so we're off just 2%. And the other complex, we're close to 70% collected, and it's normally about 79% collected.
Mm.
So we're off about 10% there, but that particular demographic has a lot of people that work at restaurants and
hmm
cleaning and those types of businesses that were just hit a little harder. But we're working with those tenants to put them on a payment plan, and we hope that as the federal money, the checks are supposed to go out this week, and
Yeah.
unemployment, that hopefully May is still good because of that money coming in.
Yeah. So, our portfolio, again, one metro, Fresno, which is, interestingly enough, very agriculture, warehouse distribution based, at least the big jobs. So, again, lots of those folks still working. But many of the tenants are in the fast food or, retail segment. So I would guess, I don't know this for sure, but I'd say probably 30% of my tenants have been impacted some way. But as far as rent collection, we're at 82% as of yesterday.
Mhm.
And comparing to March, where March was a 99.1% rent collection, we had three partial payments. So March was a good month. We're only 3% behind, right? So and my data is through the 7th. So, I don't
Yeah.
have today's numbers, obviously. But yeah, we're only slightly behind, and that equates to, I don't know what it equates to, maybe $1,500 or $2,000, that percentage gap. But yeah, April is turning out probably right like I planned. I think we did a video 3 weeks ago where I was saying, you know what, I'm going to expect a 10% kind of hit, and at that level, frankly, at that level, it's not even as bad as '08. I mean, again, I've been doing this a long time, and I had rent collections in the '08 to 2010 that were 72, 73%, right? That was rough. Not to say we can't get there, but again, what you just highlighted, unemployment checks haven't hit yet. And oh, by the way, the supercharged unemployment checks with the $600 a week kicker from the Fed and the 1,200 hasn't come. So I'm no longer worried about April, right? If we didn't collect another dollar, we'd be fine. Um, May, I was originally nervous about, but to your point, right? Unemployment checks haven't hit yet. Most of my tenants, I don't know, I shouldn't say most. Let's say 30% of my tenants will actually make more money sitting on the couch than they did at their day job.
I was just thinking that with that extra money, it
Yeah.
may kind of disincentivize people to go look for a job if they've lost one until this thing is over where they feel like they can safely find another job.
Yeah.
Um,
That is certainly going to be a choice. Yeah.
yeah. And I
Yes.
think too, to your point as well, in terms of May collections, it's really dependent on the type of tenants that you have. So if
Yeah.
you have really good tenant screening and you have tenants who have a consistency of paying their bills,
Hmm.
even when maybe times were tough, they've got a decent credit score going into this.
Hmm.
Those types of tenants are just going to be more faithful to pay when they get that money because they value not falling behind and they value,
Hmm.
staying in their apartment. So I
Hmm.
think those of us who have really good tenant screening criteria,
Hmm.
um, and tenants with generally good credit, we won't have as big of a problem in May because those tenants are going to use that money toward rent.
Yeah.
It's those that are maybe in an area where they're not, they're loosey goosey with who they bring in. They let anybody move in. They hope that their deposit's enough, to compensate for all the skips. That demographic is much more likely to just pick up and walk and
Oh
not
yeah.
communicate and not to pay, even if they're getting this extra money, because some people will just take advantage. So
Oh yeah.
I'm thankful that the procedures and systems that we have in place now have made it such that we don't have to be as worried because we truly have a good relationship with our tenants and they respect us, we respect them, and we all understand the importance of paying when we can.
Yeah, and then the last thing on this topic for me anyway is at north of 80% rent collection, assuming that continues through May, June, July, I will not ask for any forbearance or any kind of discussions with my lenders. I run a business that will survive that without issues. So I don't think the forbearance. I think too many landlords see forbearance just like tenants see no evictions. It's like, oh, I get free money. Oh, it's not free. There are going to be unintended consequences. There are going to be big ass payments due in 4 months or 7 months, whatever your payments due. Um,
Yeah, and Michael, I've talked to landlords that have all had kind of a different opinion on this topic, and I
Mhm.
think while there could be some wisdom in saying, "Hey, if my bank calls me and they say, if you need to, we'll allow you to take 3 months off, don't make payments. It'll help with your collections. We'll add it on the back end. We're not going to charge you extra interest, and we're happy to do it." I
Mhm.
know many people are saying, "Hey, if my bank calls me, I'm going to do it," and say, "Sure, that'd be a great help," because
Mhm.
it at least helps with the cash flow in case we do have a bad couple of dips. And
Mhm.
worst case, they end up paying off their lender early, for that forbearance. So,
Mhm.
I think that there's some wisdom in that. If the bank is proactively saying, "Hey,
Sure.
we'll let you do this," then absolutely it helps with cash flow. And if you have investors that you've got to pay too, and partners, it can be a way to just kind of loosen the risk of running out of cash in the next couple of months and needing a forbearance on your other loans.
For sure.
So I'm okay with that. Now, I have a couple of smaller regional banks who have come out and said, "Do you think you're going to need a forbearance? If this thing gets bad, here's our options. We
Okay.
can let you go to interest only 1 month at a time as you need it,
Mhm.
or we'll let you just not make a payment and tack it on the back end. So what do you think you need?" And I just said to my banks, "This is what I'd like to do. I'm at a higher interest rate than what I could be today. I
Mhm.
know I normally would have a prepayment penalty if I refi, but it's very attractive to try to refi and lower my payment.
Mhm.
I don't need a forbearance right now. I don't need interest only. Can I pay you a couple $100 mod fee and lock in at your current rates for the next 5 years?" So that's the approach I took with my lenders. I didn't take the forbearance. I'd rather lock in a lower payment
Mhm.
because I can make the payment. I'm
Right.
not worried yet that I can't, and keep on good standing with that bank and have them not come back and go, "When there was a liquidity crisis, you had enough money, but you didn't pay us."
Yeah.
And they can say all day long, "This is not going to impact your standing with the bank." But I
Oh,
think those of us who can weather it without asking for forbearance will have a much easier time in a relationship type bank
for
to
sure.
get loans going forward.
Yeah, there's
So
no
I've
question.
chosen not to do that, but I understand some that have. Now, what I
Mhm.
think is risky is taking a forbearance for sure on like larger apartment complexes where you've got Fannie or Freddie. The forbearance rules and the things that you can't do if you go into forbearance just to take advantage of a no payment really tie your hands to be able to keep that property profitable because you can't evict anyone the entire time you're paying back those payments.
Mm-hmm.
You can't pay investors, and you can't take a payout as an owner. So it really, really has to be an absolute last resort
Yeah.
for you to be able to do that. And I think the other risk, Michael, for a lot of maybe your listeners who have let's say it's an FHA or a Fannie Mae, conventional 30-year mortgage on a rental property.
Mm-hmm.
If you ask them for a forbearance for 90 days, you still have to pay it on day 91.
Yeah.
And even though they can't report it to the credit bureau as a missed payment that'll impact your credit score, the credit bureaus are allowing those lenders to note your file as to why there's no check mark or X in that,
Mm-hmm.
did they make a payment?
Yep.
So every lender has the right to report to the credit bureau that you're not delinquent, but a big note across the bottom, this client is in forbearance due to the coronavirus. And so while your score may not go down now, it's going to follow you for years on your credit report. And if you really didn't need to take that forbearance
Mm-hmm.
and you go for another loan in the future, they're going to be like, oh, this person needed a forbearance. They're a little riskier. Maybe they charge you a little higher interest rate to do your loan. And
Yep.
so there's always some negative consequences to asking for it. And
Mm-hmm.
so I think, like you said earlier, we want our tenants to pay rent if they can.
Yep.
We need to pay our mortgage if we can.
Exactly.
If we can't, and a forbearance really is your only option, then yes, then it's
Mm-hmm.
an option. But until then, not only do you have to ask yourself, is it the right and moral thing to do, or is it going to add to the problem of lenders maybe going under because they have
Yeah.
obligations they have to pay out but can't collect? But you have to also ask yourself, is it worth the potential impact to my credit in the future if I don't really need it?
Yeah, I totally agree. Just one clarification. Did your bank reach out to you proactively, or did you reach out to them proactively?
One of my banks reached out to me proactively.
Ah, very cool. Okay.
That I have several loans with. These are small local banks that I
Yeah.
do business with a lot. And so I thought it was really good for them to reach out proactively, just like we were with tenants saying,
Yeah.
hey, do you think you're going to be okay? They're doing the same thing. They want to figure out how many of our people do we think are going to have a problem paying?
Yeah.
And we better work with them now before they just stop making payments. And then they have a delinquent loan on their books. So the other one, I had already, before this crisis, we had been talking about how rates were down. And I had already been reaching out and saying, hey, the ones that I can recast that are now at a 1-year rate because I passed the initial 5-year lock, I want to go ahead and modify. So I had already talked to them about the mods.
Mm-hmm.
They were behind, but we're going to do it proactively. So when they called me about the mod, he goes, before you sign this, do you think you're going to need a forbearance? Because if you think you're going to need a forbearance, we're not going to do a loan mod.
Right.
So I said, absolutely not. I'm liquid on my stuff. I can keep paying. Absolutely no problem. I don't have partners that I have to ask and investors that I have to ask. I'm just going to do it. So yeah.
Very, very cool. The other thing I think we should talk about that I've seen a lot of conversation on is not the investor side of forbearance, but the owner occupant side, which is the predominant, mortgages. There's a lot of talk around servicers not being able to pay their investors, right? I think there's a Wall Street Journal article floating around that everybody is quoting that I think it was 2 million people asked for forbearance in the first 14 days, and they're expecting more. How do you do you have an opinion on how that kind of unwinds? Because again, the service, as I understand their business model, they keep some cash because they have some expectation, but this is way above what they've normally done. And, they're somewhere between 25 and $100 billion at risk in the next 90 days. And that part of the chain could be that weak link that breaks everything else.
Absolutely. I think it's number one, it's very complicated and there's no one size fits all to every servicer. But
Mm-hmm.
in a nutshell, what happens is unless the bank that issued your mortgages actually kept it, like Bank of America, they keep some of their mortgages.
Mm-hmm.
So they have flexibility to work with you and they have liquid funds through the rest of their organization that can allow them to keep paying your taxes and your insurance on the back end,
Mm-hmm.
and just delay their profitability.
Mm-hmm.
What happens with servicers, for those of your listeners that don't know, is let's say a small bank issues you a loan or a broker. As soon as they close that loan, they securitize it. So they sell it to investors
Mm-hmm.
through mortgage-backed securities, and then they sell the servicing rights to another financial institution. And that the servicing rights, what the servicer does is they collect the payments, they take a fee for doing that, and then they pass the difference on in a couple of different ways. They're responsible for paying the taxes and the insurance for most of these mortgages because they're escrowed. And then they're responsible for sending the percentage of your loan that's been guaranteed, basically like a bond rate, to these mortgage-backed security investors, which a lot of times they're funds, they're insurance companies, they're individual investors like us that buy them within our 401k. So the servicer, if you stop paying them, they don't have a ton of liquid money sitting aside to be able to make the payouts to the investors on the back end, the MBS fund, and they don't have the money set aside to pay your taxes and your insurance. So these servicers are basically, it's basically a 3 to 6 year period for them to break even on when they bought that loan's servicing rights and when they charge you fees. And they hope that so many are gonna stay paying and that they'll make a profit. But basically, now they're not getting any payments in from all these people that are asking for forbearance, which is a lot. And I think it's going to keep getting bigger and bigger, but they still have the obligations to pay on the back end. So they've come back to the Fed and said, wait a second, we don't have the liquidity. In 90 days, $75 to $100 billion have to be paid out on the mortgages on the books of these servicers based on their obligations and the things that come out on the back end. Well, if you suddenly have a huge number of percentage that can't make those payments, they just don't have the money to meet their obligations on the back end. So they've come to the Fed and said, you have to help us. You have to lend us money or we're going to go bankrupt. And what you're causing is going to cause a major trickle down. Well, the American public views that as a bailout. Oh, you're bailing out the big banks. And so it's a very bad perception issue for the federal government to bail them out when they, people are saying, well, they took on the risk to be the servicer. Well, the reality is this is very different than the normal risks that are taken, that you don't want to bail out a big bank that took a bunch of risks. So the question is it the right thing to do for the federal government to step in since they caused the problem of stopping mortgage payments coming in and help these servicers with a low-cost loan so they can pay everything on the back end until people hopefully get caught up? Well, that could take a year. So the Fed hasn't stepped in to offer that liquidity. What I read today is that they're toying with the second option, which is let these big servicers just absorb the small servicers. So have a big servicer come in that does have the liquidity and they'll take over servicing and then they can keep paying out the back end and get caught up eventually. But here's the issue that I see with that, Michael. So one, you create more cash into the system, which eventually will lead to inflation and have the perception that you've bailed out these servicers. Number two, if you have a big bank absorb a small one, in 2008, what happened is the federal government reached out to like Bank of America. I'll use them as an example. We need you to rescue Countrywide Mortgage.
I remember.
That issued all these bad subprime mortgages. So Bank of America stepped up and bought them. A few years later, the Fed and others sued Bank of America for the problems done by Countrywide that Bank of America had nothing to do with. And they were on the hook for hundreds of millions of dollars of fines and lawsuits by stepping in to rescue someone. And I think Bank of America, who's one of the big servicers, by the way, is going to say there is no way I'm going to take over another servicer unless you make me completely held harmless from anything done by that servicer before, and make sure that any of these defaults I'm not on the hook for. So that's not a great option either. But the point is there's a real liquidity crisis where these servicers can't pay. And some people say, well, just let them fall, let them go bankrupt. And the end buyers of the mortgage-backed securities, they just don't get paid. Their bond goes belly up, basically, and they just don't get a payout. And that's the risk they took as investors. And so there's that mindset too. What's the right thing to do? I don't know. If I were in control, I probably would have said, if you get this money from the Fed, the $1,200 check from the IRS, and you get $600 a month extra on unemployment, you must pay your mortgage with it, pay your rent with it. There's other food programs to get food. And if you don't, you got to pay it back. And that would have made sure that people could continue to pay their mortgage, continue to pay their rent, and the whole system would have kept going normally. But they didn't do that. And so now there's just this mass trickle down impact on the economy that could change the landscape of lending in our country for decades going forward, because there's just so much more risk in the system
Mhm.
if payments don't come in as projected.
I think you just hit the real conversation, in my opinion. So let's go back to the first part. I think the Fed caused this by saying you can forbear for 90 days, no questions asked. And I've talked to people, it's true. You call up, you say the magic words, done, right? No paperwork, nothing. So in my
Yep.
opinion, the Fed caused this. They need to create a lending program. If it's 100 billion, so be it. And charge interest, right? Charge a menial interest, so it's not a bailout, right? So we, the citizens, can profit from this one-time event, and let's get going. That's, that feels like the right thing to me to do. Is it right to have capitalist society work where the small ones go belly up and bigger ones buy them? Yeah, maybe, but that's a lot messier than people think it is. I invested through the countrywide absorption of Bank of America, and just the amount of paperwork I was mailed monthly for like a year was confusing as all hell.
Right.
So not something the average American is going to want to go through. So, that's all about existing mortgages. I think you hit the last point, is my big fear. Right now, everybody's going, well, these loans are a little more risky than I thought. Let's start looking at adding fees up front, so we have, we're more profitable sooner. Oh, by the way, let's increase our margin, right? So, instead of charging 4 or 5%, let's charge 6 or 7%. I believe lending very, very, very quickly is going to be a lot more expensive for most of us, both
I
upfront
agree
and
100%.
ongoing. Yeah. So that's
I
going
agree
to
100%, because you've
go ahead.
yeah, so you've suddenly thrown risk into something that's looked like a low risk investment on the back end, these MBS, because they're federally backed mortgages.
Mm-hmm.
They were supposed to not being shorted like they were before '08, but that's still happening.
Mm-hmm.
And so, there's supposed to be some security in the system the way that it's built. But once you say to investors, wait, at any time, the government can cause us not to be paid and not bail it out, they're not going to accept 3% on their money. They're going to say, I want 5 or 6% on my money, or I'll
Yep.
just go invest in property on my own or in the
Yeah,
stock market. So
exactly.
because of the risk, the end buyer is going to demand a higher risk premium or rate. And therefore all the middlemen all the way between have to make money too. And so the rates go up. And so regardless of what happens with interest rates and the Fed rate, the ultimate rate for real estate mortgages is going to go up.
Mm-hmm.
And the other thing that you've got going on is right now, so Ginnie Mae, which is another one of these agencies, just issued something, I think last night, that said any mortgage that any of you brokers issue today, if it goes into forbearance right after you do the loan,
I saw that.
you have to buy it back.
Yeah.
You won't take it. So now these same, let's say Bank of America, and I'm just picking on them because they're big and everybody knows their name.
Yep.
But so they're one of these lenders who keep some of their loans in-house. They sell some of them on the secondary market. And now they're probably being tapped to take over as servicers for other small ones. Now they've got added risk that if we even do a loan today, we now are risking the new loan going bad and being stuck as bad debt on our books, and we can't sell it. So lots of mortgage companies have already gotten out of the business temporarily. They're not funding new mortgages because there's no back-end buyer of mortgage backs, which is why the Fed is coming in and trying to buy them, to say, we'll buy them if you just keep lending. But now they're going to say, hey, lenders, if you do this loan, you're on the hook if these people go into forbearance. So I think it's shocking and sending shockwaves through the entire lending world and all the different pieces. And it's a real risk for a lender to issue a loan, to service a loan, to buy a loan on the back end. There's risks throughout that I think is going to be shaken until everybody's back to work as normal.
Yeah.
It's going to shake them, and then they're eventually going to raise what they charge going forward to be ready for the next pandemic or the next national crisis that causes the same kind of thing.
Yeah. And of course, as we both know, if interest rates go up, and if they go from 3.5 to 5.5, some of you might not think that's a big deal, but that's a 60% jump. in interest rates. And oh, by the way, we both know that asset prices are tied to that, right? NOI and all of that. So asset values are going to come down. They just have to, right?
Yeah. Yeah, because when it's harder to get money to purchase an asset,
Mm-hmm.
there are fewer buyers available to purchase that asset.
Yep.
And so it becomes quickly a buyer's market because a seller can't find enough buyers that can qualify. They've got to lower their price until they get to a point that the remaining buyers can. And
Mm-hmm.
so, single family house values will come down, apartment values will definitely come
Oh,
down.
way down.
Um,
Yeah. Mm-hmm.
because right now lending is actually cheaper for apartment buildings, for big ones going through Fannie and Freddie than it
Yeah.
is to buy, something with through a local lender who's going to charge a little higher for
For
you.
sure.
So
Yeah.
the values are going to come down and rates are going to go up for quite some time, I think. I think this is going to be years. Now, the question is how much are the values going to come down and how much are the rates going to go up? And we don't know, and it's going to vary by location and where you are and how good the jobs are and how much money people make and how many people still move there. You still got the same supply dynamics that could make it different market by market, but I think this is a real shift in the housing market for a while, and we just have to be prepared for it. It means those who have cash and have more set aside and can meet a higher debt coverage ratio standard that they may implement, have higher credit scores, will be able to buy, continue to buy. Those who use private money, if it's still available, will be able, to buy. And there will be a lot of opportunities, and I think a lot of foreclosures, unfortunately for many, that will still create buying opportunities for us, but at a high cost to the economy.
Yeah, just since you hit foreclosures, we'll take that to the next topic. I do see a foreclosure wave, and I use the wave term very loosely. 08 was a wave, right? It was a tsunami. I do see it. It's a wave, but it's a small one, right? It's not a big tsunami, I don't think. But I don't see any of that hitting until 2021.
Yeah, because right now people can get up to a year not making a payment without having to go into foreclosure. So you've got to get through that year period and then say how many of them are going to be back on their feet and actually able to continue, to pay their mortgage without risking foreclosure.
Yeah, and I say that because a lot of people are already and there was a Wall Street Journal article again about talking about distressed assets and everybody getting lined up to buy distressed assets. I'm like, you're a little early, right? First, prices are sticky on the way down. It's called price elasticity. And also all these delay programs, man, you can extend and pretend until 2021. Easy.
Yeah.
So it's not going to be happening. It won't be happening in 2020, at least en masse, is my opinion.
I agree.
Yeah.
I agree.
Very cool. And I guess the last topic we should talk about, again, based on social media feeds that both you and I are on, are all of these SBA lending. I guess I'll call them lending programs, right, for small businesses. Have you done any research? Any thoughts on them? Right, I think one's called the EIDL loan, which is historically was the 10K, which I heard got adjusted to 1K, and then there's the PPP, the Paycheck Protection Program. Any thoughts on those two?
Oh, I've got so many thoughts on this, Michael. I've done tons of research. And, the frustrating thing for so many people is not only is there misinformation floating around by all of it, but the SBA itself has been slow to give guidance to any of the lenders or give much information on the details of these programs at all. And they've changed their guidance and changed the wording on their website and changed the application process multiple times since this was announced. So there's supposed to be two programs. One is this economic injury disaster loan, EIDL, which originally was going to be 3.5%, and then they changed it to 3.75. So all they have really said is a business can ask for a loan to help them through the crisis. It's at 3.75%. You can pay it back over 30 years. And oh, by the way, since it's going to take us a while to process these, any business that asks for up to $10,000 will be given that as an emergency advance within 3 days. That's what the CARES Act actually says. However, the way that the language is on the SBA side is we'll give you up to $10,000, and it doesn't ask how much do you want. It just says, would you like up to $10,000, yes or no? Well, you say yes, and then you wait to see what's the up to $10,000 amount. So the way that the way that the SBA even rolled it out isn't consistent with the CARES Act that says you can ask for whatever amount you want up to 10,000 and you will get it. That's not how it's actually happening. So behind the scenes, there's all these rumors of, is it just going to be $1,000 per employee? Or is it going to be 1,000 for everyone? Or is it 10,000 for everyone? Nobody really knows, Michael, because the SBA has not released how they're going to handle it. And my understanding is even a week later, nothing has been funded. There's no way to check on your application status, et cetera. So lots of confusion on the EIDL. The EIDL is done through the SBA directly, not through banks that issue SBA loans. So they have issued some guidance, but even their guidance has screenshots of the old application way that you used to have to apply, which isn't even how they're doing it now. And all we know for sure is that you can get some loan amount offered to you. You don't know what it's going to be. If they offer you a loan up to $200,000, does not need a personal guarantee, which is good, as long as you're not an affiliate of a big company. And then there's a bunch of other questions of what happens if you are. But they also said anything over $25,000 needs collateral. So this is all that's been issued. That's all we really know. Anything else that people are saying, it's conjecture on how things might play out, but there has been no official guidance that tells you anything different. So I applied for the EIDL for all of my businesses, put in my gross income, my net, my expenses to equal the net, and how much of an economic injury I anticipate through this process. I asked for the 10,000 or up to 10,000, and I haven't heard a thing. So who knows? The second side is the PPP, and that is even more messed up because the mess up is loud and out in the public. So until the night before it was supposed to go live on the 3rd, they had not issued sufficient guidance to these SBA lenders who have to process these loan applications to answer lots of questions on the rules and what kind of documentation would be needed. They initially said that if you're an employer and you have 1099 part-time people, you could include that in your calculation of what your payroll is. The night before, they came back and said, oh, no, you can't. But the guidance still says, oh, add the amount of contractors, here's the number. And then at the end, it says, well, if you have a contractor, can you count them? And they say, no, they have to apply on their own. So there's so many questions and so much confusion. And even the SBA lenders don't know the answer to most of these questions. And so they're just doing their best to take the application and to send it to the SBA. If they're a direct lender where they can approve the loans like Bank of America, they may approve you with very little paperwork because you have a relationship with them already. But anybody else, they're having to wait for SBA to come back and approve and come back and say what documentation is needed. And I'm hearing a lot of different lenders like Bank of America, I'll pick on them again, who came in and said, if you don't have a lending relationship with us, you don't get priority and you can't apply till the 10th.
Yeah.
So it doesn't matter how big your business relationship was with them, how big your checking accounts, they would not process for you. So there was a lot of media backlash, and now they're saying, okay, we'll process for you. But the program is there. If you can get approved for it, they'll help you through the calculation. And supposedly, Michael, once you're approved, you get a certain dollar amount. You have 8 weeks between now and the end of June to pick an 8-week coverage period. And in that period, as long as you don't lay off any people during that period, or you've brought people back that you've laid off, and you spend 75% of the money that they give you on payroll and the other 25% on mortgage payments and utilities, then that is forgiven and becomes a grant. So the great thing about PPP is it's definite free money. The bad thing about it is it's hard for people to get it right now, and nobody really knows the rules and can even explain it to their clients. So it's frustrating, but it's slow, and that's what happens when you have government programs.
Yeah. Well, let's be fair, right? They've done this in record time. I mean, I'm with you. I'm as equally frustrated, right? So calling it slow is probably, let's call it frustrating, because they actually did it fast.
I agree with you that they've rolled it out in record time.
Yep.
The frustrating part is if they come out in the media, this is what I'm hearing. If they come out and say, you're guaranteed to have this in 3 days from the application. And that's what the CARES Act says.
For sure.
And that's what their website says. And then they still haven't talked to anybody or communicated any. it's slower than what they promised,
Agreed.
which is frustrating people. And it's really hard for small businesses because they thought, hey,
Oh
we'll
yeah.
at least get the 10,000 to hold us over for a couple weeks. This money's supposed to come very, very quickly. We can
Yeah.
even be approved and funded the same day. And
Yeah.
suddenly they're weeks further in not being able to bring their employees back.
Yep.
So it's a slower response than what many people hoped for based on what had been communicated.
Agreed.
And because of the fact that it's just a huge program that has a lot of things that have to be, figured out,
Yeah.
it's just going to take a little longer than what people expected.
Yeah, I think the challenge, the problem, the opportunity was missed when they promised to have it up the same week. I think I heard the Treasury Secretary come out on Tuesday and say it'll be ready Friday. That was the miss. They should have bought more time, but they were an emergency state. The
Right,
small
right.
businesses were in trouble. So I no blame at all. But the other thing we just need to point out is they're about to add another 150 to 250 billion dollars because both programs are frankly oversubscribed.
Yes.
And that's going to be probably signed on Friday. So we're gonna take these programs which are struggling to get started and just throw on another $250 million. So
Yeah.
we shall see.
And we just hope that it will keep businesses going and let them open back up, and that it'll
Mhm.
keep, all these payments continue to be made, rents, mortgages, and everything. But, the longer this goes on, the less likely that people rebound quickly. So
Yeah, yeah.
we just pray for the best.
Let's close on a positive note. So just like you and I 2 weeks ago in March, we were both nervous about April, and I think as we started this call, April turned out better than we expected. Is that fair?
Yes,
Yeah.
it is. Yes.
Yeah. So let's just leave on the positive note that these two programs, which were set up in record time, uh, with not a lot of rules, get going. Let's hope next week when we talk, some people have actually got money. I think that'd be a big deal. Let's
Yes.
also hope the $1,200 checks or wires or direct payments or whatever also starts hitting people's accounts, plus the supercharged unemployment, which I think makes our May collection hopefully as good as April, knock on wood.
It very well may be. And I think, just as a final point to kind of leave your listeners with too, the point of talking through all of these issues and, what could be a problem
Yeah,
is really to get us to prepare for the worst and be able to think through how can we mitigate it if those things happen. But
totally
we
agree.
should never get down in the dumps and say doom and gloom, this is going to go terrible, we're out. No, this is, educate yourself on what's happening so
Yeah.
that you can shift and make good decisions on, for example, cash flow. Do I ask for a forbearance now, or do I hope for the best? It's be wise into what's happening so that you can learn how to mitigate and navigate in case those things happen. But be hopeful and optimistic, because it very well could be that, the government is taking unprecedented action, and they are working to help small businesses and people, which in years past, that section of the economy really didn't get very much help. So I'm very hopeful in the fact that both parties are coming together for the most part when it matters and
Mhm.
actually doing something for the American people. And I think because of that, things will end up better than I think all of our worst case fears. And we need to remain optimistic and hopeful as those things play out. So, yeah,
I love that. Optimistic and hopeful. We will leave this interview on that topic. Thank you very much for your time.
thank you.
All right.